we are putting Xcel Brands on the anvil. This is a company that's telling a story about a big turnaround, about all the heavy lifting and restructuring they're doing. But when you look at the numbers, when you dig into the filings, well, they tell a very, very different story. It's a story of some serious structural weakness. So today, we're going to hammer this thing out and see if there's any real strength left or if it's all just slag.
Welcome to Iron Financial. Our mission here is really simple. We're here to help you forge a stronger portfolio. We cut right through all the market noise, the fluff in the press releases, and the stories that the C-suite wants you to believe. We stress test the numbers. We find the cracks in the foundation before they turn into a total collapse. Because let's face it, in this market, strength is absolutely everything.
Okay, let's just dive right into this. The whole question around Xcel Brands, that's ticker XELB, it all starts right here. On April 1st, 2026, they went to the SEC and said, hey, we can't file our annual report on time. Now, the company's story is all about transformation and rebuilding, but when you can't even get your basic paperwork in order, you have to ask a pretty critical question. Are they really renovating the business here, or is the entire structure just fundamentally completely unsound? Look, before you even think about opening a press release or looking at some glossy earnings presentation, you have to look at the regulatory filings. This is where you find the truth, right? It's not varnished by any marketing spin. And with Xcel, the very first sign of trouble, the very first crack in the armor, well, it showed up long before their official numbers ever saw the light of day. This right here, this is the filing. It's called a Form NT10K, basically a notification of a late filing. And this quote from it, this is the blaring red flag. It says, a delay in completing the audit. And why was there a delay? Because management needed, and I quote, additional time to compile and verify the data. Let me translate that from corporate speak for you. It means we can't get our own numbers straight and our auditors refuse to sign off on them. Believe me, this is not just some little administrative hiccup. This is a direct public admission of internal dysfunction. All right, hold on a second. A late filing, is it really that big of a deal? Companies miss deadlines all the time. Maybe they're just understaffed, especially after all these cost cuts they've been talking about. It just feels more like a process issue to me, not a fundamental problem with the core business. That's a rookie mistake. And it's exactly that kind of thinking that gets portfolios completely broken. A late 10K is one of the most serious warnings the market can give you. It is not a paperwork problem. It is a structural integrity problem. Let's just break this down. First off, it absolutely screams weakness in your internal controls. It means the systems that are supposed to be tracking the money coming in and out of the company, they're either broken or they're just not good enough. Second, it points to accounting complexities that they can't seem to handle. Maybe they sold off a brand or made a weird acquisition, and now they can't figure out how to account for it properly. Either way, it means the numbers are a total mess. And that, of course, delays the audit, which is your only independent check that the numbers are even real. But most importantly, it almost always, and I mean always, foreshadows some really negative surprises. When a company tells you they need extra time to verify the data, it's usually because the data is ugly and they're scrambling to figure out how to package it without sending investors running for the hills.
Okay, that's a fair point. And honestly, looking deeper into that exact same filing, it's not like they even tried to hide it. They literally checked the box on the form that says, yes, we expect a significant change in our results. It's not buried in some footnote, it's right there on the front page. They were pretty much telling the market to brace for impact long before we saw the actual numbers. So yeah, we knew it was going to be bad.
Exactly. So let's fast forward about a week. On April 7th, they finally dropped the results. And even with that warning, the official story they pushed out to the market was, well, it was surprisingly optimistic. It was a classic turnaround narrative, right? Focusing on all the positive steps they're taking. And this is where we have to stop and ask ourselves, are we looking at a real renovation here with solid structural work being done, or is this just a quick, fresh coat of paint meant to hide the rot underneath? So this is the story the market got. The press release hits the wire, and right away, the focus is shifted. It's moved away from that late filing, away from the legally required numbers, the GAAP numbers. Instead, they want you to look over here, at their version of the numbers, these adjusted, non-GAAP metrics. This is classic financial storytelling, and you really have to be careful when you see it.
And I'll admit, on the surface, this highlight reel they put out, it looks pretty good. Adjusted EBITDA for the full year improved by 35%. For just the fourth quarter, it improved 24%. The non-GAAP net loss, which, conveniently strips out a lot of inconvenient expenses, was basically flat. The narrative they're pushing is crystal clear. Our cost cutting is working, and the business is getting leaner, meaner, and healthier. This is the paint. It's glossy, it looks clean, and it's specifically designed to make you feel confident. And then the CEO, Robert D. Lauren, he comes out and doubles down on it. He says he's pleased with the progress and that the company is on track to return to profitability. So I've got to ask you, analyst, isn't this what a turnaround is supposed to look like? I mean, you slash costs, you improve your adjusted profits, you guide for a return to the black. This is the playbook. Isn't this a solid plan? No, it's a facade. That quote, that entire highlight reel, that's just the cheap drywall they hang up to hide the crumbling foundation and the cracked support beams underneath. So now we're going to rip it off. We are done with non-GAAP fantasies and management's little stories. It's time to look at the hard audited GAAP numbers. It's time to see what's really going on with this company's top line. So let's talk about this so-called progress. The company is painting a picture of a business being carefully pruned back to health, but the audited numbers, they tell a completely different story. In 2024, this company generated $8.3 million in revenue. Okay. In 2025, the year the CEO is so pleased with, that revenue wasn't just pruned. It was clear-cut. It fell all the way to $4.9 million. This isn't progress. This isn't some strategic pivot. This is a collapse. A 42% drop. Just let that number sink in for a second. A business that loses almost half of its total revenue in a single year is not making progress. It is not on track for a turnaround. It is experiencing a catastrophic structural failure at its most fundamental level, its ability to actually sell things to people. Everything else you hear is just noise. Okay, but they do have an explanation for this. They say right in the filing that the big decrease was primarily because they sold off the Lori Goldstein brand back in 2024. So, of course, revenue is going to go down if you sell a piece of the business. That seems like a pretty reasonable one-time event, doesn't it? I mean, they cut off a piece of the business, so the total size shrinks. It's just simple math. That's the story they'll tell you, but it doesn't hold up under any kind of pressure. Think about it. When you divest an asset, the expectation for a healthy company is that you're trimming the fat so you can focus on a stronger core. You sell a non-performing brand to reinvest in your winners, the parts of the business that have real potential. A healthy, growing business should show signs that its remaining operations are actually expanding to fill that revenue gap. And we see zero evidence of that here. What this 42% decline really tells us is that after selling off one brand, the rest of the business just kept on shrinking. The core isn't growing. The entire structure is just getting smaller and smaller. It's like tearing down one wing of your house because it's rotting, only to find out the rot has already spread to the main foundation. And that brings us directly to the foundation itself, the balance sheet. You know, revenue tells you what happened last year. The balance sheet, that tells you about the company's ability to survive the next year. It's the ultimate measure of structural integrity. And when we stress test Xcel's balance sheet, we see a lot more than just a few cracks. We see a foundation that is actively crumbling before our eyes. This table right here, this lays everything bare. Don't get lost in all the different numbers. Just focus on that bottom line, total stockholders' equity. This is the book value of the company. It's what's left for shareholders after you pay off every single dollar of debt. And look at it. It dropped from over $28 million to under $16 million in 1 year. $12.5 million of book value just gone, vanished.
That is a 44% destruction of book value. Let me say that again. Nearly half of the company's entire net worth evaporated in just 12 months. So you can forget that non-GAAP EBITDA story. This is the reality. This is the foundation turning to dust. Shareholder value is not being built here. It is being systematically annihilated.
And believe it or not, it gets even worse. How do you fund your operations day to day? How are you supposed to invest in all these new brands you're talking about? You do it with cash. At the end of 2025, Xcel had just $1.2 million in unrestricted cash and cash equivalents. For a publicly traded company that's supposedly trying to launch multiple new brands and engineer a massive turnaround, that's not a war chest. That's not even a cushion. It's a rounding error. They're operating on fumes, with barely enough cash to keep the lights on for a few more months, let alone fund any kind of meaningful growth.
But wait, what about their debt? Maybe they're paying that down aggressively, cleaning up the balance sheet that way. That could be a sign of fiscal discipline, right? It's the exact opposite. While their stockholders' equity was completely collapsing and their cash was dwindling down to nothing, look at what was happening to their long-term debt. It went up. It went from $6.6 million to $9.5 million. This is the worst possible combination you could ever see. the company's net worth is plummeting while its debt burden is actually increasing. They are adding more weight, more financial stress onto a foundation that is already failing. This is a classic textbook recipe for total structural collapse. Okay, the historical numbers are ugly, I get it. The foundation is definitely weak, but the company would argue that all of that is in the rearview mirror now. They have a plan. They're not trying to patch up the old business. They say they're building a totally new one. They're making a massive bet on a whole new business model focused on influencer-led brands and social commerce. I mean, isn't that where all the growth is today? This is supposed to be their big pivot. And this is their blueprint for the future. I pulled this straight from the press release. Management anticipates that new brands will drive growth. They're trying to tap into the creator economy, aiming for a portfolio of brands that can reach 100 million social media followers. You have to admit, on paper, this sounds like a modern, forward-thinking strategy to replace all that lost revenue and rebuild the company from the ground up. They're betting on the future, not living in the past. And this right here, this illustrates the core issue perfectly. Is this new strategy a legitimate, load-bearing wall? Something engineered with a solid plan that's capable of supporting the entire company? Or is it just more of that decorative drywall we were talking about, designed to look good and distract you from the fact that the house is still falling down? A promise of future revenue is not the same thing as actual revenue. Hope is not a strategy. And you know what? We don't even have to guess if this blueprint is solid or not. Their own history tells us it's as thin as paper. Just look at the summaries from their own past earnings calls. Back in Q3 of 2025, what did we see? Vague management responses on future revenue guidance. Okay, go back to Q2, and what do you find? It's the same story. Highlights, uncertainties, and delays, and a lack of clear guidance. This isn't a new problem. This is a pattern. They promise growth, but they consistently refuse to provide a concrete, measurable plan with actual targets and timelines. A solid blueprint has numbers. It has projections. What Xcel has is a long history of vague hope. So it's time for the iron verdict. We've examined the official story they're telling, and we've stress-tested the underlying structure. Now it's time to weigh the glossy paint of their turnaround narrative against the crumbling foundation of the audited financials. So is this a deep value opportunity, or is it a classic value trap just waiting to spring? Really, it all just comes down to this. On one side, you've got the paint, the story. The CEO is pleased, adjusted EBITDA is improving, they're on track for profitability, and the future is bright with all these influencer brands. It's an attractive story, a modern story. But then on the other side, you have the foundation, the audited reality. Revenue didn't improve. It collapsed by 42%. Shareholder equity didn't grow. It collapsed by 44%. They have almost no cash, their debt is rising, and this whole investigation started because they couldn't even get their own financial data verified on time for the SEC. Our verdict here is unequivocal. This is a trap. The positive story, which is built entirely on non-GAAP metrics and vague promises about the future, is nothing more than a thin coat of paint. It cannot hide the reality of a business whose foundation has been almost completely eroded. The financial decay is just too severe, the cash position is way too precarious, and their history of vague guidance gives us zero confidence in their ability to execute this supposed turnaround. So the takeaway here is pretty clear. The risk of a total failure here far outweighs the potential reward of a turnaround that, so far, seems to only exist in press releases and hopeful quotes from the CEO. That's exactly right. And that leaves us with one final question for every single investor who's looking at this stock. When you see a structure that is this fundamentally compromised, with a crumbling foundation, collapsing revenue, and rising debt, do you really want to bet your hard-earned capital on a renovation? Or do you just stand back and wait for the inevitable demolition?
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.